Let's talk about my main focus point, which is about news we've already discussed and certainly you've heard about, and that is Moody's downgrading the US credit rating from AAA to AA1. Now, the reason why they did this was rising fiscal deficits and efforts to extend the tax cuts from 2017 while US debt is ballooning to potentially an uncontrollable level. Now, the bond market didn't really like it, right? You're seeing the 10-year yield, as I mentioned earlier, back up above 4.5%, 30 years up around 5%. And it's not just treasuries. It's not just the US government that feels the pain. Treasury rates are essentially the benchmark on which every other interest rate is built. Mortgages, auto loans, credit card rates, all of them are expected to rise or stay elevated as treasury yields push broader interest rates higher. 30-year mortgage rate is closing in on 7% again. I think in mid-May, last time I looked, it was around 6.92. Not sure where it closed at last week. Credit card APRs are remaining high. The average rate is now 20.12%, close to the record that we saw last year. But it also is doing more to put Fed policy under pressure. If costs are rising, if yields are being blown out, there's not much the Fed can do. It complicates the Fed's balancing of tariffs and slow growth, reducing a lot of flexibility for rate cuts. In fact, the Fed has signaled a lot of caution. Atlanta Fed president said that only one rate cut is likely to happen in 2025. And the bigger question is, even if the Fed cuts short-term rates, if the long-term yield is blowing out, there's not much effect that it's going to have on the average consumer. Now, a downgrade, this isn't the first time the US has been downgraded. There was a downgrade in 2011 after a fight over the debt ceiling, when S&P downgraded in 2011, saying that the politicians' willingness to bring the US to the edge of default for political reasons leads us to believe that they are not a AAA-rated credit-worthy country. Fitch downgraded in 2023. None of these things upended markets. But it does highlight a persistent issue, a persistent fiscal risk. I mentioned yesterday that when a lot of people say the big beautiful bill may add $3.3 trillion to the deficit over 10 years, that is only operating under the CBO's estimate of 30-year yield not going above like 3.5%. Maybe it was 3.6%. But either way, certainly not 5%. One of the biggest expenses that the US government has. I'll pause so you can think about it. Interest on its debt. It's nearing $1 trillion. And so, understandably, an agency whose job is to rate the credit worthiness of a country decided that the risks are growing, and certainly we all need to be paying attention.